So we all focus on offices, and we'll talk about offices, but are there other parts of commercial real estate we should have been paying attention to?
Yeah, absolutely. First, I would say across the spectrum, right, commercial real estate is facing sort of this new paradigm as to where interest rates are, right? And we went through this period where we lived in a world where interest rates were near zero or low for a decade plus, which was not normal, right? And then we went through this big spike, and that really basically it impacted values of every commercial real estate sector, and anything that was financed when interest rates were low and now to be refinanced when interest rates are higher is becoming a challenge. And you look at particular sectors like multifamily as an example, where there was tremendous transaction activity in 2020 and 21 when rates were low and people expected rents to continue to go higher, and the inverse has happened, which is that rates went higher and rents stayed low. And so a lot of those capital structures are broken. And to exacerbate the problem, there was also a record level of new development of multifamily happening in the Sunbelt regions that are all coming online. So you have now new supply at the same time that you have these refinancing issues. So there's this immense re-equitization that needs to take place in commercial real estate, and particularly on the multifamily space that have good fundamentals, but it's going to require ultimately write-downs and equity injections to reset those balance sheets. And that's why I think when you think about commercial real estate today, this is much less like 2008 in the great financial crisis, where we had this distress and then the Fed was able to inject capital and values came back up, and it was a relatively quick a solution to this problem. This is much more like the early 90s, where there's going to be waves of loans that mature that then need to be recapitalized, restructured. That's going to be a multi-year process to work our way through.
Some people might be surprised to hear there may be too many multifamily homes in some places, because on the national levels, we hear a lot about the cost of housing. We have Kamala Harris, for example, having some pretty dramatic proposals about how to really have more housing because we don't have enough. So how does that work out? Do we have too much or too little?
That's a great question. And that's what makes this so interesting from an investment thesis, is that in the short term, you have this dislocation because if you have this surge of multifamily that was developed in the last few years as coming online. But as that burns off, you're going to have a drop in supply. It's already down 70%. And as interest rates have continued to rise, that's curtailed more supply. So coming out of this cycle in 2026, you're going to have more demand than there is supply available. But the next 2 years, you're going to have a situation where you can actually have entry points to buy multifamily at dislocated prices because they need to be recapitalized. They're broken capital structures today.
Scott, you mentioned interest rates a couple times. Everyone's anticipating some cuts coming from the Federal Reserve. What difference will that make? Or maybe more to the point, how much does the Fed need to cut before it really affects your business?
I think you have to think about interest rates a little bit different, right? When you think about interest rates, there's this period of time whereas the real estate industry we're really being hurt by higher for longer. And I think now we got to get used to the fact that it's going to be higher is the new normal, meaning that what we lived through the last decade and a half plus of near zero rates wasn't normal. So the Fed's going to normalize rates. Does that mean 3% to 4% is the range, but not 0 to 2% that existed for a period of time? So that still is going to require us to recalibrate values, recalibrate capital structures along the way. But the more that the industry has clarity that rates are coming down, then you'll start seeing transaction activity happening, which creates price discovery and then crystallizes values, which then I think will create a increase of more transactions.
We talked about the people who are providing the capital. We've heard a lot about regional banks, possible challenges for them in commercial real estate. A lot of talk about private credit. Who's providing the capital right now in the housing industry?
Yeah, so I would think the banking industry in general has really pulled back from providing capital to real estate. They're under a lot of pressure from the regulators to reduce their commercial real estate exposure. The commercial real estate loans that they have on the books, and many of these regional banks have 50–60% of their loans are commercial real estate loans, a lot of them multifamily, can't be refinanced because the plumbing is clogged. And so that's where the challenge is. And I think where you're seeing step in are the non-bank lenders that are coming in and actually providing those financings. We do it ourselves, more I would say on the higher yield side of that equation, but the big private equity shops. And when you think about this cycle, just like we saw in the 90s and we saw again in '08. When you have these moments of turmoil, it tends that the non-bank lender sector becomes much more of the future infrastructure. We had that with CMBS in the early 90s. We had it with the private equity coming out of the '08, '09. And I think this is going to be more of a permanent fixture, that banks are going to be more conduit to customers. They're going to focus on more investment grade rated type paper. But they're going to rely on non-bank lenders that have longer durated capital that matches those loans, which makes sense, right? If deposits can be pulled every day, if you have longer term capital that you can actually match to the term of the loan, that is something that is I think more balanced and can be more resilient in challenging times.
Let's talk about neighborhoods writ large. San Francisco, Chicago, New York. Which ones are starting to come back?
Yeah, I mean, New York it's heads and tails above San Francisco, Chicago. I say when you think about the U.S. right now, there's really two global cities that have sort of come out of the pandemic. It's really New York and Miami. The other ones haven't been able to come back. And what you have is these are urban ecosystems. And so people aren't back to the workplace. What ends up happening is the local shops can't survive to be there, right? People don't want to live downtown. Crime starts to become an issue in those submarkets. So, if you don't get that system started like we have had in New York, and I give a lot of credit to the businesses that brought their employees back, and everyone, New York being this magnet that it is, it becomes a negative downward spiral.